I have a question for you, and I want you to be, brutally honest with yourself for a second.
Okay.
When was the last time you actually opened your banking app and really stared at the numbers?
Oh,
Not just a quick panic check to see if you have enough for coffee, but like a deep audit, interest rates, transaction history, the whole picture.
if hearing that question just made your stomach drop, or if you felt that familiar little spike of cortisol, you are definitely not alone. It's the modern condition.
It really is. It's the Sunday scaries, but for your wallet. I think so many of us operate on this policy of strategic ignorance?
Strategic ignorance, that's a perfect way to put it.
If I don't see the balance doesn't exist. We just kind of float along, tapping our cards and hoping the terminal doesn't beep at us.
It's a classic defense mechanism. But the sources we've pulled for today's deep dive suggest that this anxiety, it isn't just about being afraid of a number or being, bad at math. It's a symptom of a much larger systemic issue. We are living in a moment where consumer debt, credit cards, mortgages, auto loans, it's surged to historic highs.
So the anxiety isn't irrational. It's coming from a very real place. It feels like being strapped to a rocket you don't know how to fly.
Precisely. And the root cause, according to the research, is this massive gap in what we call financial literacy. The source material makes a really compelling, almost frustrating point here. Think about your education. We're taught algebra, we memorize dates of wars.
Yeah, analyze themes and literature, sure.
But most of us go through 16 years of schooling without anyone explaining how a loan amortization schedule works, or how to value an asset, or even how interest actually accrues.
It's wild when you think about it. We're handed the keys to this incredibly complex financial machine at age 18, credit card offers start showing up, and we're essentially told, good luck, try not to crash.
And when people inevitably feel like they're losing control, it's not because they aren't smart. It's because they literally don't understand the mechanics of the machine they're trying to operate.
Okay, so that stops today. We are taking a stack of resources on Finance 101, stripping away all the Wall Street jargon, and we are going to master the language of wealth. The mission for this deep dive is to move from that feeling of overwhelming anxiety to a place of, executive control.
And to do that, we have to start with a core philosophy that underpins every single article and study we read. It's a bit of a tough love moment, but it's the prerequisite for everything else.
Lay it on us.
Financial planning is your responsibility, full stop. It is not your boss's job to make sure you can retire comfortably. It is not the government's job to ensure you build wealth.
It's all on you.
It is entirely 100% up to you.
That is heavy. It feels a bit isolating at first, but it's also the necessary switch, isn't it?
It is.
Because once you accept that nobody is coming to save you, you realize you have the agency to save yourself. So let's get under the hood. If we're going to drive this machine, we need to understand the engine. The sources call this the time value of money. Now that sounds like a college textbook title. What are we actually talking about?
It sounds complex, but it's really the foundational law of finance. The time value of money, or TVM, simply states that a dollar in your hand today is worth more than a dollar you might receive tomorrow.
My immediate thought goes to inflation. My dollar bought way more candy in 1995 than it does today. But TVM is distinct from just inflation, isn't it?
It is. Inflation is definitely a factor. It eats away at value. But TVM is really about opportunity. A dollar today has potential energy. You can put it to work immediately.
Okay.
If you wait until tomorrow to get that dollar, you've lost a day of potential growth. You've lost the opportunity to employ that money.
So money is essentially an employee. And if it's just sitting there doing nothing, it's wasting time.
Exactly.
This brings us to the mechanism of that growth, which is compound interest. We've all heard the term. Einstein supposedly called it the eighth wonder of the world.
Yeah.
But I want to get granular on how it works versus simple interest, because I think people really underestimate the difference.
Yeah. The difference is staggering. Let's look at simple interest first.
Sure.
It's linear. You earn money only on your principal, the original cash you put in.
Right.
If you deposit, say, $100 at 5% simple interest, you get $5 this year. Next year, you get another $5. The year after, another $5. It's just a flat line.
Predictable but boring. It doesn't accelerate. It just walks forward at the same pace.
Exactly. Compound interest is exponential. You earn interest on your principal, but then, and this is the magic trick, you earn interest on the interest you just made.
The source material used the snowball analogy, which I love.
Fit this one.
You roll a snowball down a hill. At first, it's tiny, right? But as it rolls, it picks up more snow. Now the surface area is bigger, so in the next rotation, it picks up even more snow.
That visual is perfect because it highlights the acceleration. Let's look at the numbers from the case study to make this concrete. Say you deposit $1,000 at a 5% compound rate. In the beginning, the curve looks pretty flat. You aren't seeing much action, maybe a few dollars here and there.
Yeah.
But you have to zoom out.
It's the hockey stick graph.
Right. Over 20 or 30 years, that mechanism of earning interest on your interest, it causes the line to go vertical. You stop earning linearly and you start earning exponentially.
And this is the catch, right? There's one critical ingredient required for that snowball to turn from a baseball into an avalanche.
Time.
Time.
Time. It is actually more powerful than the amount of money you invest. The math shows that someone who starts saving small amounts at age 25 often ends up with significantly more wealth than someone saving huge chunks starting at age 45.
That is fascinating. So the person starting at 45 might be putting in double the cash, but they can't catch up?
Often no, because the 45-year-old simply doesn't have enough runway for the compounding to really take off. They miss the years where the snowball gets its mass.
Wow. That's the time and time value of money. Time is the multiplier. Okay, so we know we need to get our money on the field immediately, but before we start throwing cash into the stock market or crypto or whatever's trendy, the sources all emphasize a defensive strategy. We need to build a fortress first.
You cannot build a skyscraper on a swamp. Before you invest, you must save. And the research suggests a specific iron rule here, the emergency fund.
And the magic number mentioned was 6 months of living expenses. Not 6 months of salary, but 6 months of what it costs to keep the lights on, the fridge full, and the Wi-Fi running.
Correct. And that number catches people off guard. It sounds like a lot of cash to have just sitting around doing nothing.
Yeah.
But this fund is your buffer. It's about psychological safety as much as financial safety. If you lose your job, or your car's transmission dies,
Or the roof leaks.
you don't have to raid your investments or run up high-interest credit card debt to fix it. It prevents you from interrupting that compounding process we just talked about.
So it's insurance for your portfolio. But here's the logistical question. I have this pile of cash, my 6 months of expenses. Where do I put it? The sources were very clear that under the mattress,
Please don't.
or even in a checking account, is a terrible idea.
Yeah, please do not put it under the mattress. You are guaranteed to lose money to inflation that way. You need that money to be safe, but you also want it to work a little bit. The material outlines 3 instruments for this defensive layer.
Okay, let's run through them. Option 1, savings accounts.
Specifically, high-yield savings accounts. These are best for liquidity.
And just to define terms, because we promised no jargon liquidity, is just finance speak for how fast can I turn this into cash to buy groceries?
Yeah, exactly. High liquidity means you can get to it instantly. You sacrifice a high return for that access. It's safe, it's there, but it won't make you rich. It's just keeping pace.
Okay, option 2, certificates of deposit or CDs.
This is a trade. You are telling the bank, you can hold this money for a specific time, 6 months, a year, 5 years, and I promise not to touch it.
And in exchange,
In exchange for locking your money up, lowering your liquidity, they pay you a higher interest rate. It's a contract.
got it. And the third option was money market funds.
These are often misunderstood. A money market fund is actually a mutual fund, but it invests in ultra-safe short-term debts, like government treasury bills. You're basically lending money to the government for a few weeks or months.
So it's a little more sophisticated than a savings account, usually offers a better yield, but is still very, very safe.
Precisely. It's a parking lot for cash, not a race car. It keeps your money safe while you figure out your next move.
So we have our defense set. We have our 6-month moat around our castle. We aren't panicking when the washing machine dies. Now we get to go on the offensive. This is the fun part.
This is it.
The sources shift here to asset valuation and investing.
This is the shift from preserving wealth to creating it. And the first concept to grasp is asset valuation. It's a fancy term, but it just means, what is this thing actually worth?
Yeah.
Whether you're buying a house, a comic book, or a share of a company, you need to know the intrinsic value versus the price tag.
The sources break down the investment universe into 3 main buckets, which I find really helpful. Let's start with the heavy hitter, stocks.
Right. When you buy a stock, you are buying equity. That's the key word. You are buying ownership.
Ownership.
If you buy a share of Apple, you are a part owner of Apple. You technically own a tiny sliver of the furniture in their office, the patents in their vault.
Which sounds great, but what does that mean for risk? Because ownership implies, well, responsibility.
It means you're participating in the fate of the business. It's high risk, high reward. If the company profits, the stock price goes up and they might pay you dividends.
Which is a share of the profits.
Right. But if the company makes bad decisions and goes bankrupt, your equity could go to zero. You are in the boat with them.
Okay, so bucket number 2 is bonds. The dynamic here flips completely.
It does. When you buy a bond, you are not an owner, you are a lender.
I become the bank.
Yes. You are lending money to a government or a corporation. They take your cash to build a bridge or expand a factory, and they sign a contract promising to pay you back the principal plus interest.
So stocks are, I own this, and bonds are, I lent money for this.
That is the perfect distinction. And because bonds are a legal contract to pay you back, they are generally safer than stocks. But the trade-off is that the potential returns are usually lower.
And then we have the third bucket, which the source describes as the vehicle for the other two, mutual funds.
Mutual funds are essential for the average investor because of one word: diversification.
Right.
If you have, say, $1,000 to invest, you can't go out and buy a balanced portfolio of 50 different companies. You don't have enough capital, and the trading fees would eat you alive.
It's like a potluck dinner approach. Everyone brings something to the table.
In a way, yes. A mutual fund pools money from thousands of people. The fund manager takes that massive pile of cash and buys a diversified mix of hundreds of stocks and bonds.
So, with one purchase, you own a tiny slice of the entire market.
And the benefit is that if one company in that bucket implodes, it doesn't sink your ship. It's a blip on the radar. It smooths out the ride.
Okay, we can't talk about assets without addressing the elephant in the room. The one thing most people consider their greatest investment: real estate.
This is where we need a bit of a reality check. Culturally, we're taught that buying a home is the ultimate financial win. And it can be. But for most people, their home is their biggest asset, yet it acts a lot like a liability.
The expert in our source material used a specific legal term about mortgages that sounded a little ominous: lien.
It's important to understand, a mortgage is a lien. It is a specific legal claim against the property. Until you pay that off, the bank effectively has a giant stake in your home.
I think people get so focused on the monthly payment, can I afford the $2,000 a month, that they forget the total cost of ownership.
That is the trap. You have to look at the full picture. The source emphasizes calculating the unrecoverable costs. It's not just principal and interest. It's 30 years of property taxes, 30 years of insurance, 30 years of maintenance.
Right. When you rent, a broken water heater is a phone call to the landlord. When you own, a broken water heater is $1,500 out of your pocket on a Tuesday.
Exactly. And unlike a stock, a house doesn't usually pay you cash flow unless you rent it out. It takes money out of your pocket every month. It can be a great wealth builder, but only if you calculate those holding costs accurately.
So we've got our defense, our offense, and we've reality checked our housing. But there's one more layer: future-proofing. We need to talk about risk and retirement.
This brings us back to risk management. In finance, risk isn't just losing money at the casino. There are these invisible forces trying to erode your wealth.
The text highlighted two: inflation risk and credit risk. Let's define inflation as a risk factor.
Inflation risk is the guarantee that your cash will buy less in the future. If you were too conservative, say, you keep all your money in a savings account earning 1% while inflation is 3%, you are safely losing money. You're losing purchasing power every single year.
That's the silent killer of wealth. Being too safe is actually risky.
It is. Then you have credit risk. This applies when you're the lender buying bonds. It's the chance that the borrower just won't pay you back.
So how do we balance these? We need growth to beat inflation, but safety to avoid losing it all. The source points to one specific tool most people have access to: the employer-sponsored plan, like the 401k.
The 401k is the primary vehicle for a reason. It offers tax advantages, but the real superpower is the match.
I love the math on this because it's the only time in finance you get a guaranteed win. Let's walk through the example.
Okay, so let's say your employer matches 50% of your contributions up to 6% of your salary. If you decide to contribute that 6%...
The company kicks in another 3%.
Right, and think about that return on investment. You put in your money, and you instantly made a 50% return on that cash because of the match. Before the market even opens, you are up 50%.
There is no hedge fund manager on Wall Street who can promise you that. It's literally free money.
If you are taking the match, you are essentially asking your boss to cut your salary. You're leaving part of your compensation on the table.
And this connects back to the very first thing we discussed, the time value of money. That extra 3% isn't just cash, it's more fuel for the snowball.
It accelerates the compounding significantly. Over 30 years, that free money, compounded, could be worth hundreds of thousands of dollars. It's the difference between retiring at 60 and retiring at 75.
So let's zoom out. We went from the anxiety of avoiding the bank gap to understanding how to build a whole financial life.
It's a progression. You acknowledge the problem, the lack of literacy. You build your defense with an emergency fund. You go on the offense by understanding assets, and you future-proof with things like a 401k.
And the big shift here, the one I really want our listeners to internalize, is the change in the relationship with money.
Yes, it is the shift from working for money to learning how money works for you.
Oh.
When you understand these concepts, you aren't just a passenger. You are in the driver's seat.
And the source material had a pretty stark warning at the end. It said that understanding these basics is the only way to avoid felony-level financial mistakes.
It's a dramatic phrase, but it's accurate. Excessive consumer debt, falling for predatory lending, panic selling when the market dips. These are mistakes that can imprison you financially for decades. Financial literacy is the key.
I want to leave everyone with a thought to mull over. We talk so much about the time value of money. We know $1 today is worth more than $1 tomorrow.
Right.
So here's the question. If time is the most critical ingredient, what is the cost of waiting? If you wait just one more year to start that 401k, you aren't just losing 1 year of deposits, you are losing the year at the end of the curve.
Where the exponential growth really happens.
That's it.
That's the sobering reality. Delaying by 10 years can cut your final portfolio value in half. The cost of inaction is often higher than the cost of making a mistake.
Exactly. The best time to plant a tree was 20 years ago. The second best time is literally right now. Go open that app, look at the numbers. Thanks for listening to this deep dive into the language of wealth.
Stay curious and start saving.